Good morning. Today's topic is the solo 401k tax exempt. So our solo 401k is really tax exempt, or is that just another financial myth? In today's session, we are diving deep into one of the biggest questions we get from entrepreneurs, consultants, real estate investors, and freelancers, for example, which is a solo 401k tax exempt? The answer isn't a simple yes or no. It depends on how you use the plan, which account types you choose, and the strategies you put in place. As always, please like today's video to help get the word out to other solopreneurs like yourself. Please also subscribe to our YouTube channel and also take a look at our My Community, where we have over 30,000 members. It's free to join. You can post forums. You can even post guest blog posts, which is popular for financial professionals to post guest blog posts so that they can get their services out to those members, and those members can visit your website as you can link that particular blog post back to your company website. Please also visit our artificial intelligence page, which is www.solo401k.ai. And again, please like this video. It'll really help us get the word out to other solopreneurs like yourself, and also subscribe to our YouTube channel where you'll receive notifications as to when we go live. You can also visit our YouTube channel to view our large video library. So here are some of the items on today's agenda. We're going to go over these items. Now, let's talk about what tax exempt means. Tax exempt means that something is free from federal, state, or even local taxes, either fully or partially. So that's the definition of tax exempt. So we're going to discuss here how that definition fits into a solo 401k plan. So go ahead and type over your questions during today's session. We'll pause and answer those questions as they come in. They don't have to be specific to today's topic, which is a solo 401k tax exempt. So some of the items we're going to discuss today are the basics. What tax exempt really means with regards to retirement accounts like solo 401k plans and even IRAs. We're going to talk about pre-tax versus Roth Solo 401k contributions regarding treatment with regards to taxes when contributions are made and even when distributions commence, generally at retirement age, or once you reach the magical age of 73, which results in having to make require minimum distributions from pre-tax solo 401k funds, but of course not Roth Solo 401k funds, as require minimum distributions no longer apply to Roth 401ks, including Roth Solo 401k plans. We're going to talk about investment growth, how gains can grow tax deferred in the case of pre-tax solo 401k funds, or even grow tax free in the context of a Roth Solo 401k plan. We'll talk about the fine print when taxes apply and when they do not. So again, go ahead and type over any questions you have during the daily webinar, and we'll go ahead and answer those questions. So what are capital gains? Well, capital gains are the profits you make when you sell an asset for more than you paid for it. These assets make up all types of different assets. It can be real estate, bonds, even selling stock in your business, collectibles, and of course, stocks and other physical assets. So again, capital gains apply to profits when you sell an asset for more than you paid. Here's an example here. Let's say you bought let's say a stock for $5,000. You sold it for $8,000. The capital gain would be $3,000. Looks like there's a typo here. So 8,000. So subtract 5,000 from 8,000, you have $3,000. That amount would be subject to capital gains if you made that investment outside a retirement plan. Let's say you made it in your personal brokerage account where you bought a stock. Let's say you bought NVIDIA for $5,000, and then the next day you sold it for $8,000. So now you're going to be subject to $3,000 in capital gains. You've got short-term versus long-term. If it's a short-term capital gain, that means you've held that stock, so that NVIDIA stock, for less than 1 year. So it's going to be taxed at the ordinary tax rates, those capital gain rates. If it's held for a year or longer, then it's going to be taxed at the long-term capital gain rates. Now, capital gains do not apply to investments held inside a solo 401k or even an IRA for that matter. So again, capital gains do not apply to investments held inside a solo 401k plan or an IRA. We often get the question of, especially clients that invest in physical real estate through their solo 401k plan, where the plan invests in a rental property. The property is later sold. The account holder will ask us if capital gains will apply. The answer is no, because that investment was made inside a tax shelter retirement account, that being the solo 401k plan. Therefore, it's afforded favorable tax treatment under the regulations. So when an investment is made through a solo 401k plan, whether we're referring to stocks or cryptocurrency for that matter, or even real estate, or even private funds, private equity, when those investments are made through a retirement account, they're going to be subject to the retirement account regulations. So as a result, from an investment perspective, since a solo 401k is a tax shelter vehicle, you're not going to have capital gains applied, whether long-term or short-term capital gains. So we'll come back to this slide in a moment here, which kind of gives you a comparison between making investments inside a taxable brokerage account. Let's say you open up a brokerage account in your personal name or in your business name, versus a brokerage account made versus making the investment through a solo 401k, where you have a brokerage account for the solo 401k. So the brokerage account is opened up in the name of the solo 401k plan, and therefore it's considered a tax-deferred vehicle. So we'll come back to this in a moment, but for now, let's talk about how when you open the solo 401k plan, you can open that plan through your self-employed business as long as you are self-employed and don't employ any non-owner full-time W-2 employees in your business. So here's an example of a one participant plan, this image on the left. Let's say Josh is self-employed in his own LLC. So Josh opens up a solo 401k plan through his self-employed LLC. So his LLC would sponsor the solo 401k plan. That solo 401k plan can then open up separate holding accounts to hold the separate sources of solo 401k funds. So one plan, so Josh's LLC sponsors the solo 401k plan. He decides that he wants to open up 3 brokerage accounts under that solo 401k plan over at Fidelity Investments. for a solo 401k offered by my solo 401k financial. So 3 holding accounts, aka brokerage accounts at Fidelity. The first one will be titled XYZ Trust. It'll have the word pre-tax in parentheses. The second one will be XYZ Trust with the word Roth in parentheses. And the third one is XYZ Trust with the word after tax in parentheses. That after tax account, that's where voluntary after tax solo 401k contributions are made. And then they are converted to the Roth Solo 401k. The Roth Solo 401k is where you make contributions, whether employee Roth Solo 401k or employer Roth Solo 401k contributions. And of course, the pre-tax brokerage account for the solo 401k is where you make pre-tax employee or pre-tax employer contributions or both. You can also transfer former employer plans to that pre-tax solo 401k account if they're pre-tax former employer funds. If you have traditional IRAs, SIP IRAs, simple IRAs, those would be transferred to the pre-tax solo 401k bucket. If you have a former employer Roth 401k, Roth 403b, TSP Roth, that can be transferred to the Roth Solo 401k. The image on the right is a 2-participant plan. Many of our clients are married and both spouses are working in the same business. So they both participate in one plan because the plan is sponsored by the self-employed business. This results in each spouse having separate holding accounts under that plan to hold their respective contributions and rollover funds. So this image on the right, you're going to see a total of 6 brokerage accounts under one plan because you have a total of 2 participants in the plan. That is, both spouses are working under the same business. Now, with regards to whether, again, today's topic is let me go back here to our topic here. The topic is a solo 401k tax exempt? So we talked about how capital gain taxes do not apply to investments made through a solo 401k. Now, regarding the solo 401k, here's an example here of a taxable brokerage account versus investments made through a solo 401k, which will give you an idea as to how it works. So capital gain taxes. So yes, they do apply to a taxable brokerage account. A brokerage account open up in your personal name or in your business name, for example. But if it's opened up in the name of the solo 401k plan, then no. Capital gains do not apply. Instead, those funds are going to grow tax deferred. And if we're talking about a pre-tax solo 401k, if we're talking about Roth Solo 401k funds, they're going to grow tax free. That's the main difference between pre-tax solo 401k funds and Roth Solo 401k funds. That is that pre-tax solo 401k funds grow tax deferred. So you're going to have to pay taxes eventually on those funds. Whereas Roth Solo 401k funds grow tax free, and you will not have to pay any taxes, whether income taxes or any type of tax, on those Roth Solo 401k distributions once you make them. So they'll grow tax free while they remain in that Roth Solo 401k plan. Now, personal investments will receive dividends. Let's say you have a personal brokerage account and you invest in a stock. Let's say you invest in let's say Apple through your personal brokerage account, and Apple pays a dividend. Well, that's going to be subject to taxes, capital gain taxes, once you distribute those funds out of there. Now, with the solo 401k, if Apple pays a dividend, as long as that investment was made through the solo 401k, that dividend is not going to be subject to capital gain taxes. It's going to stay in that solo 401k and grow tax deferred if you made that investment through the pre-tax solo 401k. If you made it through the Roth Solo 401k, it's going to grow tax free. So there's no tax deferred growth, unfortunately, with personal investments because you have to pay capital gain taxes. If we're talking about a solo 401k, again, it's going to grow tax deferred or tax free if we're talking about the Roth Solo 401k. Now, there are no contribution limits to a personal brokerage account or a business brokerage account. However, a solo 401k is subject to the annual contribution limits. So here, for 2024, the overall contribution limit to a solo 401k is $69,000. Again, we're talking about 2024. For tax year 2025 is $70,000. For 2024, for the solo 401k, if you're age 50 or older, you can make a catch-up contribution of $7,500. Therefore, you can contribute a total of $76,500. So again, contribution limits do not apply to capital gain types of investments, but they do apply to tax shelter vehicles like solo 401ks or including IRAs. IRAs have a less contribution limit, which is $7,000 for tax year 2024 and remain the same for 2025, $7,000. Taxable brokerage accounts, so they're not subject to, or excuse me, you can't take a taxable deduction when you have a personal brokerage account. Well, through a solo 401k, because a solo 401k allows for pre-tax solo 401k contributions. If you make pre-tax solo 401k contributions, that'll reduce your taxable income for the year. So pre-tax solo 401k contributions, for example, employee pre-tax solo 401k contributions reduce your taxable income on the personal side for the year. If you make employer pre-tax solo 401k contributions, those reduce your taxable income for the year on the business side. Personal investments are not subject to required minimum distributions. Those apply to retirement accounts, specifically pre-tax retirement accounts like traditional IRAs, SIP IRAs, simple IRAs, and pre-tax 401k funds. All right, so that hopefully gives you an idea. Let's see, we got a question here. Please go over steps how to take money held in bank account of the solo 401k and then invest those in other assets. Well, so a solo 401k allows you to make various types of investments, whether alternative investments like real estate, promissory notes, tax liens, private equity, physical real estate, as well as equities. So when you open a solo 401k plan, and let's say you want to invest in stocks or even index funds or mutual funds, then you're going to need to open up brokerage accounts, not bank accounts, but brokerage accounts under that solo 401k, for example, over at Fidelity or Schwab. And if you want to invest both pre-tax and Roth Solo 401k funds and equities like stocks or index funds, then you're going to need at least two brokerage accounts in the name of the plan. So it's still considered one plan. So you would open up two brokerage accounts, one for the pre-tax and the second one for the Roth Solo 401k funds. So same name, same EIN number for the plan. Because remember, the plan is a retirement trust, therefore it requires its own separate employer identification number. And the brokerage accounts will be opened up in the name of the plan using the plan's employer identification number. You then will make investments inside that brokerage account and any equity or index fund. It's an open architecture type of platform. The third brokerage account, the voluntary after tax, is not for making investments. That's part of the mega backdoor Roth Solo 401k strategy. So that you would make the voluntary after tax solo 401k contribution to that bucket, aka brokerage account, and then convert it to the Roth Solo 401k. Now, if you want to make an investment in real estate, you could also make that investment through that Fidelity brokerage account for the plan that my solo 401k offers, as we offer a self-directed solo 401k plan, and you'll actually be able to wire funds out of that solo 401k for investing in physical real estate, like a rental property. On the other hand, if you only want to make alternative investments and not any type of equity investment, you can have You can open up bank accounts for the solo 401k instead, and then make the investments and those alternative investments through those bank accounts for the solo 401k. For example, if you invest in real estate, you would wire the money from the solo 401k to the title company for that investment in real estate, and the property would be titled in the name of the solo 401k plan. And then as rental income comes in, it'll flow back to the solo 401k. It'll maintain its tax deferred status, so it's not going to be subject to capital gain taxes. So that's how that works. Okay, good question. Looks like we've got another question here. So when I open the plan with my solo 401k, we open it at a bank. Well, you open the solo 401k with my solo 401k financial, but the holding account, the actual holding accounts for the plan, you get to choose where to hold those funds. They can be held at your local bank, credit union, or even at a brokerage firm like Fidelity or Schwab. But the plan is offered by my solo 401k financial. But you get to choose the financial, the depository taking institution to hold the actual funds. Good question. Okay, let's continue with our webinar here, and then we'll come back to some more questions here. Please go ahead and like today's video to help get the word out to other solopreneurs. So we've been talking about, we're trying to answer the question, is a solo 401k tax exempt? And we've been talking about that at great length. We talked about pre-tax solo 401k funds versus Roth Solo 401k funds from a contribution perspective. So to recap, when you make contributions to a solo 401k plan, if you make them as employee pre-tax solo 401k contributions, they'll reduce your taxable income for the year on your personal side, but all the gains will grow tax deferred, and you're going to have to pay taxes on both the contribution and those gains in that pre-tax solo 401k once you make distributions, typically a retirement. When you make Roth employee contributions, when you make Roth employee solo 401k contributions, those you do not get a deduction for those contributions, but in the trade-off is that those contributions will grow tax-free. So those Roth pre-tax, those employee Roth Solo 401k contributions will grow tax-free. So while you don't get a deduction when you make the contribution, the gains on that investment, if they materialize, will grow tax-free, and you'll be able to make distributions tax and penalty-free from those Roth Solo 401k funds once you've had that Roth Solo 401k for both 5 years and you are age 59 and a half or older. From a distribution perspective, as I touched on, when you distribute funds from the pre-tax solo 401k bucket, those funds are going to be taxable because you will have never paid taxes on those funds. Again, capital gains never apply to a solo 401k, but you are going to have to pay both federal taxes and possibly state taxes, depending on your state of residence, when you make distributions from the pre-tax solo 401k bucket. However, with the Roth Solo 401k bucket, you're never going to have to pay taxes on those gains inside that Roth Solo 401k bucket, provided you've had the solo 401k for at least 5 years and you're age 59 and a half. So we're talking about this Roth Solo 401k bucket here versus the pre-tax solo 401k bucket. Now, from a planning perspective, if you have funds in that pre-tax solo 401k bucket, you can always process the pre-tax solo 401k in-plan conversion from the pre-tax solo 401k to the Roth Solo 401k. You're going to have to pay taxes in the year that you convert those pre-tax solo 401k funds to the Roth Solo 401k, but at least you can choose when to make those conversions. And typically you want to convert those pre-tax solo 401k funds in years that you're going to be in a lower tax bracket. Because when you convert pre-tax solo 401k funds to the Roth Solo 401k, that's going to be taxed at the income tax rates, which may bump you into a higher tax bracket. You can even convert an asset that's owned in that pre-tax solo 401k bucket. Let's say you bought a rental property in that solo 401k pre-tax bucket, and that property has declined in value. You can actually convert that actual real estate property to the Roth Solo 401k based on the market value of that property. Of course, you're going to have to pay taxes on the market value of that property in the year of the conversion. But the trade-off is now it'll be held inside the Roth Solo 401k bucket. So all the rental income will grow tax-free. And later on, when you sell that property and you then distribute up the proceeds from the Roth Solo 401k, it'll be tax-free. You could even distribute the property out of the Roth Solo 401k plan down the road as an in-kind distribution, and at that time you can use the property for personal use. So that's if it's held inside that Roth Solo 401k, because you won't have to pay any taxes, and then you can use the property for personal use. You can't sell the property to yourself, but when you take a distribution from a solo 401k, whether pre-tax or a Roth Solo 401k, that means it's distributed in your name. And if it's a pre-tax solo 401k that owns the property, you're going to have to pay taxes, of course. But if it's held inside the Roth Solo 401k, you won't have to pay any taxes. And now you can use the property for personal use. Okay, so that's the difference between contributions and distributions from a pre-tax solo 401k versus a Roth Solo 401k. So this is giving you, this chart here just gives you an example of making investments through a solo 401k versus your personal brokerage account or business brokerage account versus making it through the actual solo 401k. This here shows that you're going to get greater gains when you make that same investment through a solo 401k because of the fact that it's a tax shelter vehicle or a tax exempt vehicle in regards to Roth Solo 401k funds versus a personal asset. Okay, so let's take a look at here if we have any more questions. Let's see, we got a question here from James. For loans from a solo 401k with pre-tax Roth and after-tax at a bank, would each account be able to provide funds to the loaner, or does all funding need to come from one of the accounts? So I'm assuming you're referring to a promissory note where you invest a solo 401k in a promissory note as an investment to a third party. Let's say you know a real estate developer and he approaches you and you end up talking about how you have a solo 401k plan that allows for investing in trust deeds or promissory notes, for example, secured by real estate. So you would loan your solo 401k funds to that developer as a promissory note. You would notate that promissory note as having been made by the solo 401k. So the solo 401k would be listed as the beneficiary. The real estate developer, whether it's his company or in his name, would be listed as the borrower. The note payments would flow back to the solo 401k as an investment and grow tax deferred. So it wouldn't be subject to capital gain taxes. And you can make that investment through that pre-tax solo 401k or the Roth Solo 401k bucket, for example. Now, if you're talking about a solo 401k participant loan where you want to borrow from the solo 401k, that's different than a promissory note investment. So a solo 401k participant loan is when the solo 401k participant / owner wants to borrow from his own solo 401k plan, and he or she can borrow 50% of the total solo 401k balance, not to exceed $50,000. So if the value of your solo 401k is $100,000 or more, the maximum you can borrow is $50,000. Another example of the value of your solo 401k is $50,000. The maximum you can borrow is 50% of 50,000, which would be $25,000. Now, if you've got funds in that solo 401k that are made up of pre-tax and Roth Solo 401k funds, then you can choose to borrow just from the pre-tax solo 401k bucket or just from the Roth Solo 401k bucket. You never want to borrow from the voluntary after-tax solo 401k bucket because the purpose of the voluntary after-tax solo 401k bucket is to perform a mega backdoor Roth Solo 401k conversion. It's not to keep funds in that bucket. You want to convert those funds immediately to the Roth Solo 401k. But if you have funds in both the pre-tax Solo 401k holding account and the Roth Solo 401k holding account, the calculation would have to be performed with respect to a Solo 401k participant loan, where you would need to borrow some funds from the Roth Solo 401k and some funds from the pre-tax Solo 401k funds. So a special calculation would have to be performed, and we can help you with that. We would also have to draft 2 sets of Solo 401k participant loan documents, one for the pre-tax funds and the other one for the Roth Solo 401k funds. But you have to aggregate that 50% threshold that you can borrow between the pre-tax and the Roth Solo 401k bucket. In other words, you can't borrow $50,000 from the pre-tax Solo 401k bucket and then another $50,000 from the Roth Solo 401k bucket. It's all aggregated because, again, it's considered just one Solo 401k plan with separate holding accounts. So good question. So we have a questions here, another question here. What plans can you roll over into a Solo 401k? So a Solo 401k plan is oftentimes used to consolidate other retirement accounts. You can transfer traditional IRAs, SEP IRAs, simple IRAs. You can transfer former employer 401ks, former employer 403bs, former employer 457 plans, trip savings plans. However, you can never transfer a Roth IRA to the solo 401k. That's a Roth IRA restriction, not a solo 401k restriction. But you can transfer a former employer Roth 401k to the Roth Solo 401k. Great question. All right, so we've come to the end of our webinar today. Again, please like today's video to help get the word out to other solopreneurs like yourself. Until next time, have a great rest of the day.